Well, hello and good afternoon, everybody. At HR Solutions, we're very pleased to be hosting a special edition webinar today. And we have invited Anstee Co Financial Designers to lead the session on Pension Auto Enrolment. So, a warm welcome to you all, and thank you very much for joining us today. As we usually do, we're just going to start by introducing ourselves, if we may. So, my name is Karen. I'm the HR Knowledge Manager for HR Solutions. So I'm at the bottom of the screen, and I'm mainly listening today. But I'm also joined here by my colleague, Atim. She's our Digital Marketing Executive. She is here, as always, just to field any technical problems. Hopefully, of course, there won't be any. But if you should have something come up, please just use your control panel to send her a quick message, and she'll see if there's anything that she can do to help. We will be recording the session as well, so we will allow you to watch this again if you want to have a look at our website. We're also joined by our colleague Kay Melay. She is our payroll manager at HR Solutions. She will also be looking at any questions that come in that are more payroll specific. So if you have anything she might be able to help you with, we will again collate those, and she will have a look at perhaps getting back to you at the end of the session directly. So you've got some experts in the room. If you would like a copy of the slides, then please do send us through a request, and we should make these available to you. So that leaves me then to introduce our special guest speaker, Darren Amos. He is Financial Planning Designer for Anstee Co. So, welcome, Darren.
Thank you. Okay, so we're going to be talking about auto enrolment issues that are relevant to this year. Right, here we go. So as of today, this is relevant. So I'm going to go through what your employer duties are to remind people who are currently going through that process, that they're discuss potential penalties that you may find you are affected by, an issue called re-enrolment, which is going to affect quite a lot of people this year, and also a big discussion, really the main point was about MasterTrusts, which is a form of pension, which we'll discuss what that means as we go along. So just a reminder of your duties. As of April, hopefully everybody now is aware that your minimum contributions to auto enrolment increased to the full level as defined by the regulations. And that's everybody, including many, many new schemes. So there's lots of employers this year going straight on to the full level as they've only just auto enrolled this year, particularly new employers. The employer's minimum percentage is 3%, or is that what most of you think? There's also a level of 4%. Most people don't realize that's available. And the employee minimum contribution is 5%, but can also be only 4%. Again, many people don't realize that those variations are there. And there's a reason to that, is simply that most schemes are set up on a 3% and 5% basis, particularly those that have been done via the MasterTrust pension schemes. Many of those use something called qualifying earnings, which is a band of earnings, roughly equates to the basic rate tax band. And that's actually changing at the moment, which, because of the changes in the band, it will increase the costs because you're going to be paying 3% of a higher number. So moving on to the next bit. All new schemes, which is any scheme that's basically auto-enrolled any time this year or in the last few months, must complete a declaration of compliance. That's a statutory requirement, and actually failing to do that can lead to a penalty fine. Some very large companies have been caught out by that one. One company was fined a massive amount of money for not completing the declaration, and they were a national company. So something to be aware of if you're a smaller company. Has to be done by the end of the last day of the 5th month, including the month you started. So basically, if you started on the 1st of January, then you would have to fill that in before the 31st of May. Or in this case, 1st of February, declaration by 30th of June, and so on. And that declaration just basically says that you have completed auto enrolment as per the regulations, and you've enrolled everybody that had to be enrolled, you've assessed your employees, and that you've now done everything you should do. And it gives details of the scheme you've used, whichever scheme you happen to have used. Coming to the qualifying earnings band, the minimum threshold now, as of April, will be £6,136, which is up £104. The triggering threshold for auto enrolment, however, has not changed. So if somebody earns less than £10,000 per year, or £833 a month is actually how it's calculated, then that's still the same as it was before. But the upper level has now risen to 50,000, which is a £3,650 increase. So all in all, that means it's going to cost you another £106. If you've got somebody earning £50,000 a year, you're now going to be paying an extra £106 in employer contributions every year. That's simply because it's based on that band. Obviously, if your salary is below that, won't be affected. Penalties. These are issued by the pensions regulator if you have done something you shouldn't have done, or not done something you should have done. And the last set of numbers we have are for the third quarter of last year, because it takes a while for the new numbers to come out. And there were 38,000 compliant notices issued in that period, of which nearly 15,000 were just compliance notices. They were a slap on the wrist to the employer saying you haven't done something, giving them so many days to put it right. And then that's followed up by the fixed penalty notices. If they think you've deliberately not done something or not complied with a compliance notice, then you are fined. Those fines start at £400, and there's been 12,500 of those. But the escalating penalty notice follows on from that, which is a case of them saying, we think you are not taking any notice, so we're going to penalise you. And it's a daily rate they charge them, which can be as much as £500 a day. And that's every day until you put things right. So we've seen notices in the region of 30, 40,000 issued. It can make a big difference to a small business. There's also, worryingly, nearly 6,500 unpaid contribution notices, which is nearly half of all the unpaid contribution notices that have been issued in the last 6 years. And that's all in one quarter, which means the employer has deducted the salaries contributions, but has not paid it to the pension provider. Not only is that obviously not morally right, it's actually illegal. You have to pay that contribution to the pension provider by the specified date in the following month, which is usually around the 19th or 20th, depending on the actual day of the month. If you don't do that, the provider has to report you to the pensions regulator. Normally they won't do it instantly, they'll allow for a delay in the payment, but if you've missed a second one, you will certainly be reported and you will be fined heavily for that. The follow-up to that usually is that you will have to pay all the missing contributions yourselves. There was one large company had about £150,000 in backdated contributions for its members, because you can't take it out of the members again. So you have to be aware of that one. It's quite a savage, but the penalty notices have been escalated rapidly, which is obviously to a degree indicative of the number of companies now going through this, but also the fact that less and less companies are being assisted through the process as they're getting smaller and smaller. The big companies had help from the pension providers. They're not getting it now. So this hopefully is the sort of thing you need to just double check. If you're not sure what you have and haven't got, you need to just review it with someone. The next thing I want to come to is something called re-enrolment. It's not something that's really cropped up yet for most people, but every 3 years from your staging date, you are obliged to do the whole thing again. Any company that staged in 2016 will be doing that this year. And really, anybody who staged in 2017 should now be thinking about it, because you have to re-enroll everybody, and that may be just as much of a pain as it was the first time, maybe worse, because you're probably bigger now. You have a 6-month window, and you can move the date 3 months either side of your original staging date. So if your usual staging date was the 1st of July in 2016, you could decide to do it from April this year, or move it on to September this year. The reason they're allowing that is it could then be perhaps more aligned with your usual tax years inside your company. It could simplify things if something else is going on in July that would make it very difficult to do this review as well. You could align it with pay grade reviews, whatever helps your business. But you do then have to complete a new declaration of compliance, just like the first time. And you have to say that you've done all the things you should do, that you've reassessed all your staff, and the declaration then says when you moved it to. And all eligible non-members must be enrolled. And the key phrase there is eligible, because that's the one we've used all the time for auto enrolment. Eligible members are anybody who is over 22, and I will warn you that's coming down to 18 hopefully soon, and that will be announced hopefully in the next budget probably. The 22 and up to state pension age, which for most people now is 67, 68. So anybody between those two ages, if they earn more than the £10,000 per year or the equivalent of, and that is a vital statement because equivalent means £833 in 1 month. So if you've got somebody who earns £833 because they've done some overtime, they count as auto-enrolled eligible members, even if they don't normally earn that. Unless, so all these people must be auto-enrolled, unless they opted out of the scheme in the last 12 months before your auto re-enrolment date. So anybody who's already told you this year they don't want to be a member, you don't have to re-enroll them, because that would be unfair. You must write to everybody to tell them it's happened. Most providers will offer some kind of communications paperwork to do that. Most payroll providers also have a facility via their payroll system, Sage, etc. All of us have that system as well. The same criteria applies as auto enrolment for everything. So any person who's eligible but or not eligible because they don't earn enough or because they're not old enough or too old can choose to join again at that point. So it's exactly the same as starting out from scratch. But it's also important to remember that when you do this, nobody can opt out if they're not already in the scheme. They can't say, I don't want you to enroll me. You must opt. They cannot opt out until they've made a contribution again. So it's just like when we first started it out. You have to start from scratch. They're a new member. They have to go through the whole process and opt out for following the correct procedure. And the new declaration is exactly the same as the first one. And even if nobody was auto-enrolled, so if all your staff are already members, you still have to do this. And you still have to produce the declaration of compliance and submit it within 5 months. But this is slightly different because it's from the original anniversary date. So although you might have moved your date from July to September, you still have to actually do it 5 months from July for the declaration. So it would only be 2 months after you've auto-enrolled, re-enrolled. And on that, you state which date you chose, but your original auto-enrollment date is always your original auto-enrollment date. So every 3 years, you'll have to make the decision whether you want to move it 3 months again, one way or the other, or stick to the original date. And I highlight again that there is always a penalty for failing to complete your declaration. It will be at least £400, probably much more than that. And they are clamping on that one particular. Moving on to MasterTrust. I did say I'd explain what this is. There are currently, these are most of the pensions that have been auto-enrolled are MasterTrusts. Currently, there are about 85 of those registered with the pensions regulator. It's a specific type of pension scheme. They include most of the well-known ones that you'd be aware of, including Nest, the People's Pension, Now Pensions, Creative, Carey, Aegon, Aviva has one, Legal and General has one. There are some specialist ones like the BCF pension or Islamic pensions, which is actually Carey's, Fidelity, Smart Pension. There's many, many more. They're all identifiable, generally speaking, by the fact they have something like about the word trust somewhere in the title of the pension scheme. MasterTrust or trust is normally what they say. But the concern is, in February 2016, so it's been going on for a while, Ros Ortman, who was a pensions minister at the time, is now Baroness Ortman. You might well have seen her a lot on the TV at the moment. She's quite vocal about things at the moment. Has expressed concern over master trust schemes in particular, mainly because most of them are simply too small to be able to continue supporting their members. And that's quite a concern if you've been investing your employees' pension funds into a scheme that could fail. And that is a real issue, and it's been looked at several times. And obviously the big worry is that that could lead to your members losing their pensions, and nobody wants that, because that would not only be bad for them, but also very bad for the whole concept of auto enrolment. And you'd find people opting out, thinking it would go back to the days when they didn't believe pensions were any good. But how is it now? Well, currently there's only a voluntary standard. It's called the MasterTrust Framework Accreditation. And these standards were set by ICAEW, who are the Chartered Accountants Federation. And they drew up a load of criteria about what a good MasterTrust scheme would look like, including whether it was financially stable, what options they had if things went wrong, those sort of things. The worrying thing about that is only half of the top 25 companies actually achieved that accreditation level. Some of the well-known ones didn't. Whether they chose to be accredited, not to be accredited is a different matter, but they certainly didn't get it. There was also a period when De Facto, who are an insurance industry assessment, who offer star ratings, were only rating some of these schemes as 1 and 2 stars out of 5. So that does show you the kind of standards that were set. But anybody who got the auto enrolment MasterTrust accreditation at least had made an effort to try and get things right. But what's changed? It was announced in October that all MasterTrust schemes must now apply to the pensions regulator for reauthorization. And a whole new raft of standards were set that they must meet, including much tighter control on client monies, much more sustainable things. One of the major things was that they had only until the 31st of March to do this. So it's 5-6 weeks time, or they have to cease trading. And at the same time, the pensions regulator announced that it could take up to 6 months to approve this. So they would have actually had to apply to authorization the day it was announced in order to get through in time for the start of the tax year. Didn't seem to have thought that one through very much. And that is the problem, that there wasn't a lot of time for it. The deadlines are hard. And if you think that only half the schemes will meet in the lower standard, it does make you wonder whether they can achieve the higher standard. The new standards involve things like people must be fit and proper, demonstrating honesty, integrity, and suitable knowledge. You would have hoped that that was the setup already with somebody running a pension scheme. They must have robust IT systems and a robust administration process and governance to ensure the scheme can run properly. Well, again, you'd expect that to be a standard on any pension scheme anyway. Continuity strategy to protect members of the scheme fails, including how it would be wound up. Now, this one's quite important because that's where most of them were failing. The worry that Baroness Altman had was that this now means that they must be able to do that not using the members' funds. They must always have sufficient contingency funds to completely cover the cost of winding a scheme up. And most of them don't have that sort of funds available. And to get the accreditation, they've got to spend even more money. The scheme funder must be a proper company, as you'd expect, specialising in MasterTrust business. Now, MasterTrust is actually something that anybody can set up, which was the worrying bit. As long as a law firm draws up the trust, then anybody can set up a MasterTrust. They don't actually have to be a pension provider. And then they just set a pension scheme up and that's it. So the financial sustainability is a bit, maybe able to cover the running costs without affecting members' funds, even if it's wound up. That's key because at the moment, most of the schemes, most of the funds are going into the members' funds. So there are no additional funds available after the running costs are met. So they've got to build a reserve. So who's still in? Well, over 30 of those 85 companies so far have decided they're not going to. So if you happen to have a scheme that with one of those 30, you need to change it. At least 6 of the remainers have also already merged with another company. So we're now down to less than 50. And out of those, only 5 so far that we know of have applied for authorization. And I say that we know of because they will not announce anything until after April to let us know who's actually been authorized or not, and we don't know who's applied. But we do know only 5 companies so far have, because they've announced they have. Nest actually hasn't applied yet, but as they're the only scheme actually supported by the British government, I would suggest that that's an automatic assumption they will go ahead. And in fact, they have been granted another £329 million to use as the reserve funds they need to meet the regulations. So almost certainly they're going ahead. So they're not, but they're not one of those 5. So you could say there are 6. But the key is we won't know until April who is still trading, which means you don't know until April whether the scheme you currently have in your business is actually going to be available to your members from April payday. And we won't know until the 5th of April. So is it time to review? Do you or anybody else you know use a MasterTrust scheme? Probably yes. Most people have. The majority of people have MasterTrust schemes. In fact, the top 3 biggest providers are all MasterTrust, so almost certainly. Is it fit for purpose? So does it do the job? Is it still on the list is probably the starting point of that. But more importantly, is it still the right sort of scheme for your members? Is it actually what you want? Does it achieve for them the outcomes in the future? And if it's not, if it doesn't meet any of those things, or it's not on the authorized list, you must replace it immediately. You will still have the same obligations under the workplace pensions regulations to have a pension scheme for all your staff that you contribute to. And all new members of staff you take on in April will have to have a pension scheme the day they start. And if you haven't got a pension scheme that's still alive, you've got a problem. The other problem, of course, is if you haven't, it's going to almost impossible to get one sorted out immediately. So we're looking for a headache on the wall. So there may yet be things to come that we don't know yet about yet. They may announce a stay of execution for some of these schemes to give us time to move on. But any scheme that's pulling out the market is meant to make arrangements to transfer all the members to a new scheme. But as of yet, we've heard nothing on that. So that's pretty much everything I had to say, really. Thank you.
Wow, well, thank you very much. We have had some questions come in actually before the session started today, so we've inbuilt those into our webinar session, but I think some pretty interesting and surprising facts that you just gave us. I think everyone's going to be having to keep their finger on the pulse, really, aren't they? Especially April, to see what's going on. Right, so let's skip ahead and see what has come in. So the first question we have, if we can trouble you, Darren, it's generally publicised that minimum total contributions will increase to 8%. So I think it might be fair to say that quite a lot of employers at the moment are seeing that information and think that 8% is the minimum that will have to be contributed from April. However, from what you said at the beginning, it's possible that the total contribution from April could be 7%. So someone's picked up on this. Just wondered if you could clarify then if that is correct.
Yes, it is. There are 4 different levels of contributions to auto enrolment, but most people only have one. As I said, many companies use qualifying earnings, which is based on that qualifying earnings band, and that is usually set up as 3% for the employer, 5% for the employee, giving a total of 8%. It doesn't have to be like that. The employer could offer to pay 4, in which case the member could pay 4 as well. Or the employer could pay 5, the employee could pay 3, but it's still 8%. The other 3 options depend on your definition of earnings, and they all relate to not using qualifying earnings. So we're talking about people's whole salary, which tends to be how old-fashioned schemes were always set up before we invented auto enrolment. They just complicated it with qualifying earnings band. So everything you earn, you paid a contribution based on the percentage of that. And there are 3 different definitions of the actual salary. So that can give us a level of either 7%, or 8%, or 9%. And the 7% one is 3% employer and 4% employee. The 8% is 3 and 5 again. And the 9% is 4% employer and 5 member. Now, obviously that, because it's based on all earnings rather than the qualifying earnings potentially means that much more money is going to be paid into a pension scheme. So yes, there are scenarios where people could have 7%, but it would have been a choice at the time when they set the scheme up.
Okay, thank you. Yeah, it's not something that's perhaps immediately obvious when you see a lot of the communications about pensions changing. So I suppose it's a reminder to always keep in touch with the pension provider and check what our terms are. Okay, so another question that came in: are penalties issued to employers or the pension provider, or could it be both? So what happens there?
Well, all the responsibilities for auto enrolment are the employers. So whether you use a financial advisor to set your scheme up, or your scheme's run by a payroll people, anybody who makes a mistake, it's still the employer's fault. Yeesh. So the employer is the one who gets penalised, and there's no comeback normally on anybody else. So you have to be aware that you are liable for all penalties. So any breach, late payment contributions, not enrolling people you should have done, anything like that will be reported and you may be fined. They can make you pay all the contributions missed. However, providers can also be fined if their systems fail sufficiently to put you at risk. So they do have a liability. The major one here has been now pensions. They have been fined quite heavily for not collecting the contributions. They've only just in the last few weeks been approved as meeting standards again. And now this is before the authorisation for the new level. So they may miss the gate on that one. But they have been penalised massive fines.
Gosh, I don't know. It seems it's really surprising that all the fallback seems to be on the employer, regardless of who makes the mistakes. Do you think that's fair?
Fair. Perhaps not fair, but it was meant to be to highlight to employers how important all of this was.
Mm. Fair enough. So could you just, for the sake of clarity then, confirm what a MasterTrust scheme is and how that perhaps differs to other schemes?
Yeah. To an employer, they all look very similar. They all have the word pension in the title. They all contribute. But a MasterTrust specifically is an occupational pension scheme. So it's always an employer scheme that's used for multiple non-associated employers. So you're all one member of a massive scheme that lots of other employers are in as well. Each employer is in a separate little separate section of their own in the MasterTrust. That's why it's called a MasterTrust. The company holds all of the money within one trust. That's designed to help reduce operating costs, improve governance on the investments. Members' funds are part of the collective, but are reimbursed for that member. So you get your own individual statement, but all your investments are held with everybody else's. Mm-hmm. The most common alternative in auto enrolment is a group personal pension. And as the name suggests, it's a group of individual personal pensions, just the same as you would get if you were self-employed and went to an advisor to get a pension. The individual funds belong to that member and can be easily moved if they change employers because it's just their own fund. It's not part of a group fund. But you still get the same discounts of bulk buying to reduce costs, the same governance just like a MasterTrust, but the whole arrangement is far more flexible for the member. It also means you as a member can choose to have a different investment strategy to what your colleagues have.
Okay, thank you. The next question is one that I snuck in. So thinking about the fact that it's possible that some employers could still just be contributing 7%. So if it's possible then for employees in an existing MasterTrust scheme to have their total contributions increase to 7% rather than the 8%. And if the MasterTrust scheme did not meet the new standards by the 31st of March, would employees have to be entered into the scheme, and therefore would have to be at the contribution rate of 8%? So could some employees benefit?
In theory, yes. Yeah. Any employers can choose to use the 7% certification option, or the 8 or 9%, based on all pay instead of qualified earnings. However, saying that, many MasterTrust schemes are not actually geared up for anything other than qualified earnings, as their systems were always assumed people would only do that. So if you moved and your current scheme is already set up at 7%, but you had to move to another MasterTrust, you might find they don't allow it.
Mm.
Transferring to a group personal pension instead would allow you to make any decisions you want, because they're much more flexible. But obviously that's down to the employer.
Yeah, yeah. Okay. So many variables. And another question we had then comes through before we set up. So how would you advise an employer to find out if their scheme is fit for purpose?
I suppose it depends what you mean by fit for purpose, really. If all you're looking for is to know if it still exists, the first thing you do is ask the provider if they're going for authorisation. And those that are will tell you they are.
Mm-hmm.
That's how we know 5.
Okay.
Then when the pensions regulator finally releases its list, you can check that list to see what's approved. That will be on the pension regulator's website.
Right.
And any scheme that's on that list will not be approved.
Okay.
Right? If, however, you want to know if it's actually going to provide the best outcome for your members in the future, then really you need to speak to an advisor.
Okay.
And preferably an independent financial advisor who specialises in these things. There are different types of advisor. Many advisors employed by benefits consultants are not qualified pension advisors, and these can be identified as they're not authorised to advise the members, whereas you'll find that financial advisor would always offer to have a workshop with the membership as well, so they can talk them through what this all means. And this is because financial advisors are authorised and regulated advisors by the FCA, our governing body, and we have access to the full range of investments in the market as we know which companies provide what services. We may offer better alternatives and still take your instructions as an employer. So the level of contributions is still set up the way you want to set up. But at the end of the day, the regulations specify how much they, irrespective of what type of scheme you have, as a minimum. All right.
All right. Yeah, that's fantastic. I think that's really helpful. Thank you very much. We might just see if we can slot in another question that we've had through during the session, if that's all right. So, if we agreed at the outset to match employees' contributions, can this now be adjusted back? So, for example, if it was agreed to match up to 5%, and all employees are now on 5%, then total contribution is 10%. It is a group personal pension. Can we amend on the re-enrolment?
Very good question, Matt. It's actually more to do with your employee contracts, because if you've offered as part of your terms and conditions a matching contribution, to change that will require them accepting a new contract. The pension scheme can be changed at any time because the legal minimum is 3%.
Right.
But that will be superseded if you've already offered your staff. It's a bit like saying we're going to take you would have been paid £20,000 a year when they're going to pay you 19. They couldn't agree to it, and you can't do that. So, so it's the same thing. If you've offered that as part of their terms and conditions, you'd have a difficult job getting that through, I think.
Yeah. Yeah. Fantastic. Okay. Well, thank you so much. I didn't know if you just wanted to.
Yeah, anybody who's got any questions that haven't been answered, if you want to drop me an email, happy to answer any queries. And I think it's worth to pass it back to HR Solutions to pass out to everybody if it's more of a general query. Thanks very much.
Fabulous. Well, thank you very, very much, Darren. So yeah, anybody, if you do have any questions for him, then please do feel free to send those through, and we'll direct them as appropriate. So of course, Darren's services, as he has just described, in terms of how we might be able to help you, we do offer a pension administration service. So once you have chosen and been set up with your own pension provider, we can offer a pension module to you, and this is comprised of 3 key areas. All right. And essentially what we do is look to automate the process and eliminate the ongoing day-to-day administration burden that can come with that. So we can do things, for example, such as automating assessments with employees. We do automated data and payments to your pension provider. And we also automate communication to employees, so the creation of any letters to individuals, sending the communications out about any changes, any pending and historic communications that you might need to put across as well. It is all something that we can look to arrange for you on your behalf for your employees. So if you do have a provider set up, you may then want to contact us about how we can administer that process for you. So that really just leaves me to thank you, Darren, once again, for hosting this special edition session for us today. I think it's been quite eye-opening and it's given us some valuable insights and information. I said at the start that if you had any perhaps more pay-specific queries, then we do have Kay, our payroll manager, who has been here with us this afternoon. And if you would like to send any questions across, she is more than happy to have a look at those after the session, and we'll get back to you directly. And of course, any other HR queries, please feel free to send it across too. And I myself would look to come back to you directly. So you can always give us a call on this number on screen or contact us at the email address there too. And this webinar will be available on our website for you to watch, normally uploaded the next day or two. Here's just a quick slide showing you some of our upcoming events. If you'd like to join us, meet us face to face, we've got some employment law sessions, 2 of which have sold out already. And we've also got some absence management sessions coming for the future as well, which we are looking at having a bit of a focus on occupational health and also mental health. So they're going to be interesting sessions. If you'd like to find out more, please do give us a call. So that just leaves me to say thank you to you for joining us today and listening. Thank you for keeping in touch. And thank you for watching today. Take care. Thank you. Bye-bye.